Gold registered a new record high today, with safe haven demand driving its price above $25.50 per ounce in the futures market. At the same time, everyone's still trying to calm down from the events earlier this month. Meanwhile, the stock market is staging a furious rally that is not matched by anything else. Stocks say everything's okay, gold says there's absolutely no way. And gold has a ton more company behind it. Joining gold, we've got falling oil, gasoline, and even diesel. Diesel's at its lowest price in over 2 years. Now, while growing weakness across China and Asia is a factor in oil, gasoline and diesel, that's all America. It's globally synchronized after all. Then there are interest rates, and I sure as hell don't mean the Fed's current plan or lack thereof. Even though we are well within the September window, and I said just a few days ago I expect rates to rise a bit because of that, they aren't. The benchmark 10-year Treasury is only a few basis points above its early August low. Even the 2-year note is tracking back under 4%. In forward rate markets, they've also barely budged from the liquidations and volatility that started out this month. Now, they've consistently priced first a burst of rate cuts now into the early part of next year, and second, a focus on spring 2025 as the thing, which that hasn't gone anywhere either. While stocks may have had July retail sales last week, gold, energy, and rates have had basically everything else. And that everything else is tied directly to the potential for surging unemployment in the U.S. as well as other places around the world. Even the ECB is starting to get nervous on so many weak signals. 2 weeks after the world got shaken up by recession fears, if you look at only stocks, you'd think these were just a one-time thing. Everything else shows what happened was the equity market, which had been asleep this whole year, got jostled awake by the initial rumble of recession, only to fall right back asleep again as Jay Powell whispers a few Goldilocks rate cuts in everyone's ears. But the cycle continues to march on, and everywhere outside of stocks, it's been confirmed. So while the world and the financial markets made huge moves earlier this month, they didn't give them back. Not so far anyway. 2 weeks into this thing, and nothing really has changed ever since that door opened. But the stock market anyway, stocks want to go higher. As Mike Green always points out, the simplest algo in the entire financial world, money comes in, buys stocks. And that's what everybody does outside of those few cases when the stock market is forced to liquidate by the real world. This is a really good description of where stocks are. It was written just today in Bloomberg. A drop in equities on Tuesday interrupted what would be the S&P 500's 9th straight day of gains, its longest winning streak in 2 decades. In a stark contrast to the extreme negative momentum seen during the panic selling of early August, stocks made a rapid U-turn among strong flows, positioning, and improved investor sentiment. Like I said, everyone was asleep beforehand, they got jostled awake, and they went right back to sleep as soon as practical. Back to the article. The, quote, Momo guys are driving the bus, said Kenny Polcari at Slate Stone Wealth, referring to momentum traders. Now the volumes have been trending lower as we move into the end of the month. Moves will be and are exaggerated as a result. I think the recent rally is proof of that exaggeration, but let's see. It's always tough to bet against the stock market because the stock market is whatever the stock market wants to be. If everybody believes that the recession has been called off, then everybody's going to be buying stocks, regardless of whether or not that recession has actually been called off. And that's what the rest of the markets, which have to deal with the real world, are not saying. They're not saying the recession's been called off. It was just a one-time scare. They're saying everything that we thought and were concerned about beforehand have actually been confirmed. In the gold futures market, the price hit $25.64 earlier today. And as Reuters said, gold prices marked a record high on Tuesday as investors flocked to the safe haven asset amid a record-breaking rally driven by expectations that the Federal Reserve will deliver an interest rate cut next month. No, it's not about the Fed's rate cuts, though it is in part about interest rates. As interest rates go lower, it makes the cost of owning gold that much less because gold doesn't pay an interest rate, and so the opportunity cost for owning gold is what other interest rates like treasuries pay. So if you think treasury is going to pay a lot less on interest rates because they are already paying a lot less on interest rates, it makes owning gold that much less disadvantaged. So the more the marketplace feels that rates are going to go down, not because of the Fed or only because of the Fed eventually catching up to where the market is, the less there is inhibiting people from owning gold. There's less opportunity cost to owning other assets. So gold prices surge in response to the same risks that drive flight to safety in U.S. Treasuries. Back to Reuters. Gold traders are refocusing on the prospect of lower U.S. interest rates, again, not the Fed, which has attracted Western safe haven seekers back to the market, as shown by inflows into physically backed products, at least according to Karsten Menke, an analyst at Julius Baer. Now, while we're going to hear lots of chatter about China in gold buying as well as in energy prices, and that is absolutely a part of it, we can't dismiss the fact that the U.S. economy is very much a part of driving this safe haven demand as well. It's not just China that's in trouble. That's what the jostle earlier this month was in financial markets around the world. Remember, the Japanese stock market crashed because U.S. recession fears triggered that backlash in CLOs and risky U.S. dollar corporate debt. This is a globally synchronized phenomenon that people are waking up to the fact that it is not just China or Asia or certain parts. It really is going to be globally synchronized. And I've mentioned copper to gold prices quite frequently because of the company that copper to gold ratio is actually in. Very, very rare company, and not the kind of company that you want to be associated with. Even with copper prices rebounding from their recent lows back a couple weeks ago, copper's moved back into the $4 per pound range at the CME. Despite the fact that it staged a little bit of a short-run rebound, the copper to gold ratio, because gold prices continue to go higher too, has only backed up a very, very small amount from what had been a multi-year low in the same company as 2020, 2016, and December 2008 and February 2009. But as I said in the introduction, it's not stocks versus gold, it's stocks versus gold and everything else. And that everything else starts with WTI, gasoline, and diesel prices. With oil, it's easy to make this about especially China. China is the world's biggest oil importer, huge energy user, and the Chinese economy is clearly the weakest out of all of the major economies around the world. But this isn't just about China. The weakness is spreading everywhere else. With tensions in the Middle East falling, coming back down and calming back down, oil prices have gone back lower as well because we're refocusing. The market has to refocus on weakening demand, starting with China, but also now considering what's happening in the U.S. So oil prices have fallen below $74 per barrel, at least in WTI terms, just today, which is the lowest since the early August liquidations. And it has people talking about China. Amrita Sen, founder of Energy Aspects, told CNBC demand is driving the market right now, which we all know, with prices responding to very weak data out of China. Traders have largely faded geopolitical risk premium as there has been no supply disruption. The bearish view is quite simple, and in the medium term, slowing economic activity, weakness in Asia, and softer refinery margins all don't bode well for crude prices going into the end of the year, according to Brian Leeson, global oil analyst at RBC Capital Markets. That's what he said in a client note on Sunday. So they say demand is the big problem, but it's also China. But it isn't just China. It's also the United States, China in the U.S., and Europe and all of the rest of the world, globally synchronized recession. You can chalk it up as Chinese weakness in oil, but you can't in diesel. Remember diesel prices? There was a couple years ago where we worried about we were going to run out of diesel. Trucks were going to stop running. Everything was going to grind to a halt. Times have surely changed here. From back at the end of May, it was reported that diesel demand had fallen to a 26-year low. Here's what Bloomberg said back at the end of May. U.S. diesel demand plummeted to its lowest seasonal level in 26 years in March, driven by slowing economic growth. Not slowing economic growth in China, slowing economic growth in the United States. The deteriorating diesel warning is a warning signal that broader oil demand growth could be at risk, according to Dennis Kistler, Senior Vice President for Trading at BOK Financial Securities. Consumption of the fuel tends to fall as the economy slows. Obvious common sense. And a slowing economy presages waning demand for other fuels. Refining margins are already showing weakness in Asia, while in the U.S. they've come off their earlier highs. And while that was 2.5 months ago, nothing has changed since then. The only thing that has changed is diesel prices that were falling back then when demand was tailing off have gone even lower. As of the latest data for this week, diesel prices have fallen to, on average for the entire United States, $3.68.8. That's not just that's the lowest price since January of 2022 for diesel. So we got the lowest demand earlier this year in 26 years. Diesel prices have gone lower since then, part of it from seasonality, but mostly because demand in the United States is not there. It's not returning. It was never there. Weakness all over the place. And of course, WTI oil prices, I mentioned, under $74, down to around $73.38 when I started recording. That's the lowest since August 5th. And gasoline, wholesale gasoline prices at $2.24 per gallon at the CME. That's the lowest since January. The summer driving season, which was supposed to be driving the entire economy, as well as energy markets and prices, never showed up. It didn't materialize. Instead, what we've seen is renewed weakness in all these categories, economic categories as well as commodity and energy categories. Diesel falling down on demand, gasoline down on demand. Take away the Middle East distractions, commodities want to go lower because the economy has gone lower. The stuff at the early part of this month wasn't a one-off. It was just when the stock market and some of the more risky and complacent parts of the financial system finally realized that this was a real problem. Jay Powell had been saying soft landing, strong and resilient. Suddenly, he doesn't look so good either. We're supposed to be in the September window. We are in the September window, but it isn't showing up in treasuries. Treasury yields have moved up only a little bit from their August lows. And while they still could go higher in that September window, so far they are resisting it, which is itself a pretty bad sign. The 10-year U.S. Treasury today at 382. That had been as low as 378 on August 5th. That was the lowest point. So only 4 basis points off the low from 2 weeks ago. The liquidations, flight to safety, collateral, all of that stuff. And it had been as high as 392 last week with the retail sales report, then right back down by 10 basis points so that it's just barely off the low. If you're looking for some good news in all of this, it's that the bull steepening, which had really accelerated up until the early part of August, that hasn't been reignited. The curve shape has been largely static since the early part of August, so you could take that as a positive that it hasn't bull steepened anymore, though you could also take it as a negative because it means nothing has actually changed after the last 2 weeks. The 2-year Treasury, that one had gotten as low as 3.88% on August 2nd, and that popped up by 20 basis points over the couple weeks up until last week when retail sales report came out. And as of today, it's between 4% and 3.99%. And remember, the 2-year had been 4.29% back at the end of July and 4.5% just a week before that, back on July 22nd. So it's still closer to its lows, the liquidation flight to safety lows, than it is to where it was at the end of July. So as far as the Treasury market is concerned, the cash market, nothing has changed since the early part of August. We've backed up only a tiny bit, and backed up only a tiny bit despite the fact that we are in the September effect window. Equally important and equally impressive in all the wrong ways, joining gold safe haven demand, forward rates, term SOFR futures. Over the last couple weeks, just like treasuries, term SOFR futures had moved a little bit more, retracing that big move into the liquidations, the flight to safety, the hedging early part of August. The December 2024 contract, for example, that had priced at 95.925 on August 5th. That was its highest price, meaning lower forward interest rate expectations for SOFR. And remember, this is December 2024, so we're talking about the fourth quarter into the first quarter next year. 95,925 was the highest price. That backed off by about 25, 26 basis points through last week, August 15th, retail sales and everything else. And then today we're back up to 95.71. But more importantly, the curve continues to focus on that March to June window next year. What the market is saying is that's where we expect the recession to finally really hit and everything move in that direction, including the rate cuts out of the Federal Reserve. The June 2025 contract, that one had surged all the way to 96.71 in price as of August 2nd. Then it backed off to 96.395, so pretty substantial backing off. Retracement as of last week, last Wednesday, and now it's back to 96.51 and moving higher again. So what the SOFR curve is telling us is that it still, even now, 2 weeks later, still expects a rapid series of rate cuts right out of the gate from the Federal Reserve that's going to keep up until that part of next year, until the spring of 2025. And then from there, rates are going to continue to go lower, but it's tracing out the classic recession pattern where the Fed panics into trying to catch up to where unemployment has already gone by doing heavy interest rate cuts right from the beginning. Not that interest rate cuts do anything, which is why they turn into a series of them. And that's really what the market continues to expect. And remember, we don't take SOFR futures contracts as predictions of future interest rates. They're giving us a probability spectrum. And when you put those together, what you see is that the market is saying more and faster rate cuts from the beginning, and then a higher degree of uncertainty from the middle of next year, with the probability distribution skewed heavily to the downside. So rates go down quickly, and then the market is still trying to assess what the likely path from there might be. But the path from there is for rates to go substantially lower than where they are now, and to get there quickly right out of the gate. That's what the SOFR futures market is pricing today. Not all that much different from what it was pricing on August 2nd and August 5th. So if all you look at is the stock market, you think, well, that was just nothing more than a transitory hiccup. Everything's fine. But when does the stock market ever price anything other than everything's fine? The only time stocks go down is when something forces stocks to sell off. Forces. Every other time, stocks are going to go higher. That means nothing about the real economy. At the same time, stocks are going up, so is gold. Gold is going up as the market for gold, safe haven demand, also expects lower interest rates for the same reasons that we're talking about here. And the reason that interest rates are expected to be lower is that, first of all, interest rates are lower, and they're staying lower despite September. And forward markets are expecting them to go even lower still, consistent with the sharp spike in unemployment. And in addition to interest rates and forward rates and gold, energy. Take away the Middle East tension and the geopolitical premium, and suddenly oil prices are all about demand. And it's not just demand in China, though China is definitely a part of it. With gasoline and diesel, we see that U.S. demand is incredibly weak too. Gasoline prices are lowest since January. Diesel prices have fallen to their lowest since January of 2022. Weakness in U.S. demand. So did anything change since early August? Well, yes. The markets that were suspicious of everything that's unfolding, recession risk and unemployment and all the globally synchronized natures, all of it, they had those fears and suspicions confirmed. So something did change earlier in August. It was only that everything that we thought that was going to unfold is actually unfolding. This cycle is still a cycle, and we're now reaching that final stage of it. One of the more ominous signals that we've gotten from the financial markets, copper to gold in very rare company. And I talked about that rare company, what it means, at the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.